Thank you. The gentleman from Texas, the chairman of the House Small Business Committee, Mr. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you for all of you being here today. As we've heard today in this hearing, innovation will help to drive and strengthen our economic growth. We need to empower the private sector to develop innovative solutions to give more individuals access to financial services to bring more people into our banking system. One way the government can help incentivize innovation and help our nation's entrepreneurs is through the tax code. When an entrepreneur sees the opportunity to keep more of their profits, a good word, not a bad word, profits, from a successful business venture, they are more likely to take risk and invest in their capital. Unfortunately, the Biden administration wants to increase taxes on businesses and decrease the incentive to bring these new innovations to the marketplace. So without proper profit incentives, it will be difficult to convince entrepreneurs and startups and investors to take risk and deploy their own capital. So, Mr. Reuter, as a banker for over 34 years, can you discuss the effects that increasing taxes will have on innovation within the banking industry, and how would this hurt investors who are taking the financial risk to bring new products to the market?
You know, it goes without saying, the more money that's left in the private sector, the more innovation that happens. And we've seen this time and time again. Today, we like to talk about big companies like Apple and Microsoft, but let's remember they started as small companies with entrepreneurs. So it absolutely would be beneficial to keep taxes as low as possible.
Well, if you have more money, you loan more money. Pretty
Correct.
simple. Smaller banks often rely on partnering with third-party service providers to offer similar services to their larger counterparts. Current law authorizes federal regulators to examine these third-party service providers to assess potential risks they pose to individual banks and the banking system. Now, the problem is that the results of these exams are not shared between the federal and state level, leading to duplicate exams from both regulators. That's kind of like what government does. And I have a bill to fix this common sense issue by sharing these regulatory exams across the board, and this will promote more of an efficient supervision of third-party services that are heavily relied on to provide a wide variety of banking services, saving smaller entities time and resources. So, Mr. Knight, could you talk about how over-regulating smaller entities affects their ability to operate?
Yes, thank you for that question. As is common sense, regulation requires there's a regulatory barrier that has to be paid for. Now, there may be times and situations where that's entirely justified, but if we don't regulate based upon the risk generated by that entity and instead regulate on the basis of speculative, hypothetical, or sort of an inapt model, we risk imposing greater costs. You referenced taxes earlier. You can view regulatory costs in some ways as sort of the flip side of taxation. Both are necessary to some degree, but excessive amounts of either are going to have negative consequences that are undesirable. And in both cases, we should be striving to figure out how to achieve whatever legitimate benefit we're trying to achieve in the most efficient and least invasive way possible.
Well, and it's a way of inflation too when you do this. So
you can certainly make that argument. You can make an argument that regulation allows, a sort of excessive or complex regulation allows for, the provision of favors. There are any number of challenges or problems to excess regulation.
Since day one of taking office, the Biden administration has brought back the heavy hand of government regulations. Now, this is hurting banks and third-party service providers that have been crucial in expanding access to financial services for business and entrepreneurs across the country. Democrats' regulation policies will require banks to hire more compliance officers. Well, we need banks to be hiring more loan officers so they can get money to Main Street businesses quickly, and rather than having to navigate the complex web of regulations so quickly. Mr. Burlaw, can you discuss how this regulatory uncertainty coming out of the Biden administration is harming community banks?
Yes, well, a community bank, even one compliance officer, one extra employee for compliance, as the research from the Mercatus Center and others have shown, can it creates a trade-off as far as banks making loans. So there's definitely regulation, as we say at competitive enterprise, is very much a hidden tax. So when it's not rational or related to the problem, that's especially a cost.
Yeah. Well, I'm in the car business, and everybody in my business is on commission. And I've even had to hire a compliance officer. And you guys have heard me say, how the heck do you pay a compliance officer on commission? If you think of that, let me know, would you? And I just closing out, I'd like to say, Ms. Lee went to Baylor, I went to TCU. Go Frogs. I yield back.
Sick and Bears.
All right, great to have that rivalry on full display. The